Here is a question I want you to sit with for a second. What if the thing that feels most like a solution to your money problems is actually the thing keeping you broke? Not because you're bad with money, not because you don't work hard enough, but because a system, a very old, very carefully designed system, was built specifically to make you feel like borrowing money is the smart move. Right now, somewhere in America, someone is walking out of a dealership with a car they couldn't afford to pay cash for, feeling great. Someone is clicking approve on a buy now, pay later offer for a couch, feeling responsible. Someone is consolidating 3 credit cards into one new loan, feeling like they finally got their finances under control. Every single one of them just stepped into a trap that's over 170 years old. And the wildest part, governments helped build it, corporations perfected it, and nobody put it in the school curriculum. By the end of this video, you're going to understand exactly how that trap works, why your brain is practically wired to fall into it, and most importantly, how to use that knowledge to make decisions that actually move you forward. Let's go. Let's start with a scene that I think most of us know very well. You need a new laptop. Your old one is dying. Your screen flickers. It takes 4 minutes to open a browser. You've been limping along for months. You go online. The laptop you actually want, the one that would genuinely make your life easier, costs $1,200. You don't have $1,200 sitting in your account, at least not money you feel comfortable spending right now. So you almost close the tab. And then you see it, a little banner at the bottom of the product page. 4 payments of $300, or $42 a month for 36 months, 0% interest for the first year. And your brain does something very specific. It stops thinking about $1,200. It starts thinking about $42. And $42 a month, you spend more than that on subscriptions you forgot you have. So you click approve, and it genuinely feels like the financially responsible choice. Now here's where the problem lives. Not in that single decision. That one might actually be fine. The problem is in the pattern that decision is part of. Because the average American household currently carries over $100,000 in total debt. Mortgages, car loans, credit cards, student loans, personal loans, buy now, pay later balances. All of them started with a moment exactly like the one I just described. A reasonable sounding monthly number, a feeling of control, a signature. So the question is, how did we get here? How did borrowing become the default setting for everyday American life? Because it wasn't always this way. And understanding how it became this way is the most important thing you can know about money in the modern world. To understand the trap, you have to go back to 1856. The Industrial Revolution is in full swing. Factories are producing goods at a scale the world had never seen. And one company, Singer Sewing Machines, has a problem. They can make sewing machines faster than people can afford to buy them. So they do something radical. They introduce the installment plan. For a small down payment and a few dollars a month, a working-class family can take home a sewing machine today and pay for it over time. Sales explode. Singer becomes one of the most successful companies in America, and every manufacturer watching takes note. This is the birth of consumer credit in America. Not invented by a bank, invented by a sewing machine company that needed to move inventory. The installment plan wasn't designed for your convenience. It was designed to solve a sales problem. Fast forward to 1919. The automobile has arrived. Henry Ford figured out mass production, but a car still cost the average worker nearly a full year's salary. So General Motors creates GMAC, the General Motors Acceptance Corporation, the first dedicated auto loan company in American history. Suddenly, you don't need a year's salary, you need a down payment and a monthly commitment. Within a decade, over 60% of all cars sold in America were purchased on credit.
America didn't just fall in love with cars, it fell in love with the idea of owning things before it could actually afford them, and that love affair was engineered. Now, here's where governments enter the story directly, and this is the part that most people never learn about. 1944. World War II is ending. Millions of veterans are coming home. The U.S. government faces a real problem. How do you keep millions of veterans economically stable in peacetime without creating mass unrest? Their answer? Make it easy to own a home. The GI Bill created government-backed mortgages with low down payments and affordable interest rates. For the first time, a factory worker with modest savings could own a house in the suburbs. But here's the part the history books leave out. A person who owes money on a house shows up to work every day. They don't protest, they don't destabilize things. Debt is one of the most effective social stabilization tools ever invented. The strategy worked so well, it became a template. In 1950, the first modern credit card launches. By the 1960s, Bank of America is literally mailing unsolicited credit cards to thousands of Californians who never asked for one. Think about that. You wake up one morning, there's a credit card in your mailbox. You didn't apply. The bank decided on your behalf that you should have the ability to go into debt immediately. Then comes the move that changes everything and that almost no one knows about. 1978, the U.S. Supreme Court rules in the Marquette National Bank case that banks can charge interest rates based on the laws of their home state, not the customer's state. Banks immediately relocate to South Dakota and Delaware, states with almost no interest rate limits. Overnight, credit card rates that were capped around 12% can now legally climb to 25, 28, even 30%. And in 1980, Congress passes the Depository Institutions Deregulation Act, formally removing federal interest rate ceilings on consumer loans. One court case, one piece of legislation, hundreds of millions of Americans affected, none of it taught in schools. By the 1990s, credit is not just available, it is everywhere. Pre-approved offers in the mail, low introductory rates, rewards points, cash back. The entire consumer lending industry had been deregulated, digitized, and scaled. Between 1970 and 2000, total consumer debt in America grew by over 800%. Not because Americans became irresponsible, because systems designed by governments and corporations made borrowing the path of least resistance.
Okay, so now you understand how the system was built, but understanding the history alone doesn't protect you. Because the trap doesn't just work because of external systems, it works because of internal ones. Your brain has been the lending industry's greatest accomplice this whole time. Let me show you exactly how. When you see a price tag that says $1,200, your brain registers something called payment pain. It's an actual neurological response. The same region of your brain that processes physical discomfort activates when you think about spending a large sum of money all at once. But when you see $42 a month, something remarkable happens. The payment is separated from the pleasure of getting the thing. Psychologists call this payment decoupling. And when payments are decoupled, the pain signal in your brain drops dramatically. You're not spending $1,200, you're spending $42. Your brain treats these as two completely different financial realities, even though mathematically they are the same thing, or worse because of interest. There's another trick at work too. It's called present bias. Humans are wired to feel the benefits of things that happen now much more intensely than the costs of things that happen later. The laptop arriving tomorrow is vivid and exciting. The 36 monthly payments starting next month feel abstract, distant, almost theoretical. So your brain essentially discounts the cost and inflates the benefit. Every time, for almost every person. This is not a character flaw. It is human wiring. Now add the approval dopamine hit. When a lender says, "Congratulations, you're approved," your brain releases dopamine, the same chemical behind a gambling win or a social media like. The approval itself feels like an achievement. You earned something. The emotional reward of being approved often overshadows any rational consideration of whether the loan is actually a good idea. And finally, the identity sell. Look at how consumer credit is marketed. It is never about the debt. It is always about who you get to become. Drive the car you deserve. Live in the home you've always wanted. Upgrade your life today. They're not selling you credit. They're selling you a better version of yourself on borrowed money with interest. The lending industry did not create these psychological tendencies. They commissioned decades of behavioral research to understand and map every single one of them, and then they built trillion-dollar systems designed to deploy them at scale, every time you open a browser, walk into a store, or check your email.
So what do you actually do with all of this? The goal is not to be afraid of all borrowing. Some debt, used strategically, builds real wealth. A mortgage on a property that appreciates, a business loan for equipment that generates income. The goal is to stop being a reflexive borrower and start being a conscious one. Here is a simple framework, 5 questions. Run them before you sign anything. Question 1. What is the total cost, not the monthly payment? Always do this math before you do anything else. Take the monthly payment, multiply by the number of months, and add any fees. That number, the total you will actually pay, is the real price. Make your decision based on that, not the banner on the product page. Question 2. Does this thing grow in value or shrink in value? A car loses roughly 20% of its value in year 1. A phone is worth half what you paid for it by the time you finish paying for it. You are paying interest on something that is actively becoming less valuable while you sleep. A rental property, a business, a skill that increases your earning power, these are different. Borrow for things that grow. Be very careful borrowing for things that shrink. Question 3. Is this a want or a need? And am I being honest? There is no judgment in either answer. Wants are legitimate. Life is not just a spreadsheet, but the trap only works when you dress a want up as a need to justify the decision to your rational mind. If it's a want, own it. Then decide if the total cost is worth it. Question 4. Can I sleep on this for 24 hours? Lenders profit from urgency. Limited time offers, today only, act now. These phrases exist because a customer who waits 24 hours is far more likely to walk away. Build in a mandatory cooling-off period for any borrowing decision above a few $100s. The deal that expires tonight will almost always be available tomorrow. And if it isn't, there will be another one. The most dangerous borrower is the one who never calculates. The safest one is the one who always does the math before the dopamine hits.
Let me leave you with a story. 2 co-workers, same age, same salary, both 27 years old, making $60,000 a year. Marcus decides to live how the system expects him to. A car payment of $450 a month, a furniture set on a 12-month plan, a laptop on buy now, pay later, some credit card spending he pays minimum payments on. By the end of the month, about $900 is going toward debt. Jordan lives simply, keeps the used car, buys furniture secondhand, saves and invests that same $900 a month into a low-cost index fund, averaging 10% annual returns. In 10 years, Marcus has a car that's almost paid off, furniture that's a decade old, and roughly $8,000 in savings. In 10 years, Jordan has over $170,000. Same income, same timeline. The only difference was what they did with the gap between what they earned and what the system expected them to spend. Here is the thing I want you to take away from this video. The system was not designed with your wealth in mind. The installment plan was designed to move Singer's inventory. The government-backed mortgage was designed to stabilize a post-war nation.
The credit card was designed to generate fee and interest revenue for banks. Every piece of this architecture serves someone, and in most cases, it isn't you. That doesn't mean you're helpless. It means you need to be informed, because the one thing the lending industry cannot account for is a customer who has done the math. A customer who knows that $42 a month is actually $1,512 over 36 months. A customer who knows that the approval notification is a dopamine trigger, not a reward. A customer who knows that urgency is a sales tactic, not a real deadline. That customer changes the game, because that customer is no longer playing by the rules that were written for them. That is who this channel is for. Every week, we break down the systems, the psychology, and the history behind money so that you can make decisions based on how finance actually works, not how it's been marketed to you. If this video gave you something to think about, share it with someone who's been feeling stuck with money, not because they're bad with it, but because nobody ever showed them how the trap was built. Like and subscribe if you want more of this, and drop a comment below with the first loan you ever took, and whether, looking back, you'd make the same call today. I'll see you in the next one.